afternoon, everyone, and welcome to Money Matters TV. I'm your host, Evelyn Klein-Whitfield, and I'm an enrolled agent, a practicing tax practitioner, and I specialize in tax resolution services. Now, if you wonder what that means, it just means I get to represent you before the IRS. And speaking of the IRS, our guest today is Nick Yzzi of Canon Capital. I guess he spent some time working with the IRS, and he'll have some interesting things to say to you in a few minutes about what's going on with all this tax legislation. I'm going to do just a little bit of housekeeping and take care of a question that a viewer has sent in. Mary Alters from Philadelphia says, I received a notice from the IRS and I threw it away. Am I in trouble? Well, Mary, I don't know if you're really in trouble or not because you didn't bother to open the letter. And I would strongly suggest that anyone receiving letters or notices from the IRS or any other government agency for that matter, at least open the envelope and read it, making sure that you recognize the time requirements to respond to that letter. Most notices from the IRS can be handled very easily on your own. If you run into problems, you can contact the IRS directly. If you have issues that require professional assistance, be sure to contact a reputable CPA, tax attorney, or an enrolled agent like myself. We can walk you through the process of resolving your issues. If you have questions regarding contacting Money Matters TV, this is how you do it.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Okay, now I'm going to turn this show over to the person that really matters. Our guest is, again, Nick Yzzi from Canon Capital. Good afternoon, Nick. How are you today?
Good, Evelyn. Thanks for having me on the show.
Delighted. I know you're going to talk a lot about the new tax bill, and if you have any funny stories about your time with the IRS and you have time, you can throw those in as well. But I'm going to shut up and take notes because this is important information you have. So have at it.
Thank you. Okay, as you know, I'm from Canon Capital CPAs in Hardeeville, Pennsylvania. And as you know, we are looking at the One Big Beautiful Bill. I may refer to that as HR1. If you can go to the next screen, please. Before we start that, I just want to mention a couple of things. Just for your information, I'd suggest you get an online IRS account because you could look up information about your account. You could also look up a letter that you may have received and thrown away. But more importantly than that, that IRS identity PIN. There were 2.1 million taxpayers last year who had fraudulent tax returns prepared on their behalf. And then when they try to file their own return, they get a letter from the IRS saying, your return's already filed. So somebody stole your identity, filed a return, got a refund. It takes about 20 months to get that resolved for you to get your refund. And IRS has about 387,000 cases in their inventory to resolve. So this is not a problem that's going away very soon. So I suggest you look at that, Google those two things that I have on the screen and get an online account and an IRS identity PIN. Next screen. And then one other thing, if you're in Pennsylvania, you have a corporation or limited liability company or professional association, you have to file an annual report each year. You can see the dates when they were due. Some are already due, but you need to file by the end of the year. Go to that link online at pennsylvania.gov. So if you have any organization, any entity that was established through the Pennsylvania Department of State, you have to do this, or you may have your canceled and you can lose the use of your business name. So just some information there. So the next screen, we're going to talk about the One Big Beautiful Bill. What is it? It's a 900-page document. I'm sure all your congressmen read it from start to finish. And it basically makes permanent the Tax Cuts and Jobs Act of 17. That was President Trump's first tax act when he came into his first term. And that was set to expire at the end of 2025, which we're in now. 62% of taxpayers would have seen a tax increase if it was not extended. So that's what this does. It extends it. It repeals or sunsets most of the IRA green tax subsidies. IRA doesn't mean individual retirement account. That's Inflation Reduction Act. And most of those provisions in the Inflation Reduction Act really had to do with green incentives, energy and solar and stuff like that. But it does, the bad part, it increases the deficit by $3 trillion over 10 years. And they're saying the tariffs will change that, but we'll see about that. It adds new provisions, some of which are effective in 25 and some in 26. The deductions for tips, overtime, seniors age 65 or over, auto loan interest, these Trump accounts for newborns, charitable deductions for non-itemizers. We'll talk about all those. Next screen. It makes permanent the 7 current tax brackets established under the TCJA of 2017. So our brackets are still 10, 12, 22, 24, 32, 35, and 37. The lower 2 brackets are going to get an adjustment bump where it's going to be resulting in a little bit less tax, nothing significant in that regard. And then these brackets are going to be adjusted every year for inflation. And these new brackets start effective 2026. The next slide, please. Long-term capital gains rates. Many people may not know that if you have an asset you sell that you own for more than a year, you get a different tax break. It's a lower tax rate than the brackets we just showed you on the previous screen. So what are the long-term capital gain rates? They're 0, they're 15% or 20%. And let me just go through what that is. If you're married, if you have income up to roughly $97,000, there is no tax on your long-term capital gain. And if you have income up to $600,000, your rate is 15%. And if anything over $600,000, then your rate is 20%. So on that first $96,000, you're not going to get any tax, and most people are not aware of that. But if you do have a rate of 15 or 20%, you have to take into fact 3% net investment income tax that also applies, and then your state rate. So in Pennsylvania, it's 3.07%. So if you had a long-term capital gain rate and you're in the highest bracket, the 20%, your total tax on that capital gain, counting that, the 3.8%, the Pennsylvania rate would be 26.87. If you're at the 15% area, somewhere between 97,000 and 600,000 of total income, and then your total tax long-term capital gain rate is going to be about 21.87% when you factor in the 15%, the 3.8, and then the 3.07 Pennsylvania tax. So really no change to the long-term capital gains rates. Changes a little bit for those people who had that extra incentive in the lower 2 brackets. So that's a good thing as well. Long-term capital gains rates, basically the same. Next slide, please. Standard deductions, as you know, under the first Tax Act, the TCJA in 17, effective 2018, they tried to eliminate or at least mitigate the number of people that had to itemize their return. So they basically doubled the standard deduction, hoping that people wouldn't have to keep track of their medical, interest, taxes, contributions, and it has helped. So those rates haven't really changed substantially, but right now the rates are standard deduction is 14.6 for single and married separate, 21.9 head of household, married 29.2, and then you can see what the rates were going to be for 25. But it not only increased them a little bit more and made them permanent. So now for a married joint return, the standard deduction is going to be 31.5. So that's going to be higher than what was anticipated to be for 25 at 30,000. So next slide. Charitable contributions, because the standard deductions have been raised so high, they basically more than doubled now at this point. What it did do is it lowered charitable giving, because some people give at the end of the year because they want a tax deduction. Maybe they don't have that sense of philanthropy, but they just want to lower their taxes. So some of the charities have been hurt by that. So there's a new provision which basically states that you can deduct $2,000 if you're married, $1,000 if you're single, in addition to the standard deduction that you receive, or in addition to your itemized, you already have your itemized deductions, but it would be for non-itemizers, you can deduct even though you're not itemizing your deduction. So that's good, but also establishes a floor. So the first 5/10% of your AGI would not be deductible. So if you had an income of $100,000 times 5/10%, that's $500. So the first $500 would not be deductible, but anything over that would be deductible as a non-itemizer, subject to this new provision. Next slide. The one you probably heard and read about quite a bit was the SALT deduction, state and local taxes. And under the current law that came in 2018, income taxes and property taxes were limited to $10,000. So if you had, estimated tax payments and you had real estate taxes on your home and it was 18,000, you can only deduct 10,000. So a lot of people were hurt by that. In particular, people in the blue states who had the higher state income tax rates. So some say it was a vendetta of the Trump administration at the time to punish the blue states, but that remains to be seen. We're not going to get political here, but that's some of the stuff that went on. So there's a lot of compromising going on with the new law, which basically increased the SALT deduction to $40,000 for 25. And then there's going to be a 1% increase for the next 4 years, going up to, or next 5 years, going up to 2029. So that's a good thing. There are phase outs. And what are phase outs? Basically what that means, in this particular phase, there's phase out for $500,000 for a married joint return. So once you hit $500,000, that deduction starts to get reduced until you hit the higher level phase out. So for the SALT deduction, once you hit $600,000, it gets completely eliminated. So at $500,000, you get a full deduction, and then from $500,000 to $600,000, it decreases until it goes down to zero. So there's quite a bit of these phase outs as we go through here that basically eliminates a credit or a deduction for high income taxpayers. So it's a good thing about the state and local tax deduction. And if you are phased out, and you end up going over that $600,000 for just a married filing joint return, your deduction will never be less than $10,000. So it would revert back to the old prior deduction, current deduction. And then in 2020, 2030, it reverts back to $10,000 for everyone. But and I know that there'll be another tax law, and depending on who's in office, that may or may not be what it is today. Next slide. Child tax credit right now, you don't have exemptions any longer. That was eliminated as well under the TCJ Act of 17. But for a dependent child, you get, if they're under 17 years of age, you get a $2,000 tax credit. Now that's dollar for dollar reduction. That's more powerful than a deduction. It's a credit. So you get that. If your tax liability is $5,000, you get a $2,000 tax credit. Now your liability is $3,000. So it comes right off your tax liability. But anyway, current law is $2,000 tax credit for each qualifying child. If you have older children over 17 or elderly parents that you're caring for, who are basically your dependent, then you get a $500 credit for those. But under the new law, that $2,000 increases to $2,200 per child. So that's a good thing. And then there's a refundable portion that has increased. So in essence, let's say you have zero tax liability and you have a child that's qualified for $2,200, you would actually still get, because that portion of the credit is refundable, you would still get a $1,700 deduction, even though you had no tax liability. And that's going to be effective in 2026 as well. And next slide, please. Trump accounts. It's a new tax advantage investment account for a child, basically from newborn to age 18. It's an incentive for people to start saving for their children. Not necessarily as an IRA where they're earning income, or a 529 where it's for education, but to just start a savings account for those who are starting out in life and basically getting a jump on investment. So that's a good thing. If you, I'm trying to get my picture off of that slide, but maybe Tim can do that. But anyway, it's limited to $5,000 a year. There's no deduction for that, which is okay. And employers can contribute to it up to $2,500. That's included in the $5,000. But tax exempt organizations who give grants and stuff can give unlimited amounts to an individual. So that's a good thing. So no deduction, but you can save at least $5,000 per child. Next screen. They can be rolled over to another Trump account in their entirety. No distributions are allowed until age 18. And at age 18, they basically take on the nature of a traditional IRA. So basically, if you take money out of a traditional IRA or a Trump account before age 59 and a half, you're going to be subject to early penalty withdrawals. But the withdrawals of direct contributions would not be taxable because you didn't get a deduction for it. But the earnings would be taxable if you take money out before age 59 and a half. So that's a good thing. That's effective July 2026. But it's also effective for any child, next screen, born in 2025. So that's a little bit of a mismatch. Next screen. There's a pilot program whereby the government's going to contribute $1,000 for each eligible child born from 2025, January 1st, 2025 to 2028. even though you can't fund it until July of 26. So there's a lot of uncertainties about that. So do you take a credit of $1,000 on your tax return if you set up one of these accounts? Will the government open the account? It seems as though the government's going to establish an account for you. So it remains to be seen, but it's a good thing. The government starts you with $1,000, and then you could put in $5,000 a year and let that grow over time. And by the time that child's 18 years old, not that they want to take it out, if they did, they'd be subject to penalties and send some tax on the earnings. But that would be a good thing for a child to get a jump start on life as far as investments are concerned. Next screen. Is there really no tax on tips, overtime, and Social Security? I mean, I just heard it again yesterday. There are no taxes on tips, overtime, and Social Security. That's not true. If you want to know something about the tax law, listen to your tax advisor and not to politicians, because the Republicans will tell you there's no tax on tips, overtime, and Social Security. The Democrats will tell you that this is a tax law for the rich only, the millionaires and billionaires, and neither of them are true. So if you can go to that next screen, if we have any time, I'll show you who really does pay taxes in the United States as far as historical numbers are concerned. Tax deduction for tips. There's a new deduction up to $25,000. It's not true that there's no tax on tips. A person who's earning tips still has to pay taxes and report their tips. They pay income tax on it, Social Security, and Medicare. But what they will be allowed to do is deduct $25,000 against their income tax only, not FICA and Social Security. So, I mean, it's better than nothing, but it's not true that there's no tax on any tips. There's again going to be a phase out for married joint people that starts at $300,000 and $150,000 for all others, and then it's going to get reduced for every $100 by $100 for every $1,000 of just gross income above the threshold. This is a deduction available to non-itemizers, so that's a good thing. And IRS has already come out with a list of 70 occupations that are eligible, and it's the standard ones: restaurant and Uber drivers and hotel people and things like that. So it's a good deduction for those folks, but it's not true. Some are going to be disappointed when they prepare their tax return thinking they're not going to pay taxes on their tips. The other thing about this is the IRS is coming out with some preliminary regulations, or some FAQs, as they would say. And basically, it has to be voluntary tips. So when you go into a restaurant and they say for parties of 6 or more, we're imposing an 18% mandatory tip. Right now, those mandatory tips are not going to be eligible for this reduction or for this deduction for the employee. Now, that could change later. It seems unfair, but that's considered a mandatory tip and not a voluntary tip. So we'll see what happens down the road. A lot of this will be changing on the fly. Next screen. Tax deduction for overtime. It's a new tax deduction up to $12,500 for every single person, $25,000 joint, and it applies only to income only and not Social Security and Medicare. Similar. And I failed to mention about the taxes on tips. You have to file jointly to be able to get it. If you file married separate, you're not going to get the deduction for tips. You're also not going to get the deduction for overtime. So also subject to the same phase outs as the tax for tips. It's going to be adjusted. This information will be on your W-2, probably not for 25 because these companies couldn't gear up quick enough because they're in the middle of the year. But it is effective for 25, but you're going to have to, probably your employer's going to have to supply you information as to what your tips were that you reported. But in the future, it's going to be on your W-2. So it's a good deduction. That's fine. But it only applies to the overtime piece. So if you get paid time and a half, it's only for the half portion. It's not for the regular portion of your pay. Next slide. Tax deductions for seniors age 65 or over is an interesting one. Because of what's called the Byrd Rule, they were not able to change anything relating to Social Security. So it's not true that you're not going to pay tax on your Social Security. You're going to get a deduction for every person over 65. And if you're married joint, obviously that would be $12,000. And it's not even tied into Social Security. You just have to be 65. You don't need to be collecting Social Security. So that's another misnomer that people are going to be confused by. So there's phase out rules again. It starts between 150 to 250 married joint. Once you hit 250, you're not going to get the deduction. And for a single person, once you hit 175,000 AGI, you're not going to get a deduction as well. So there's still a lot of other rules that we're not sure about. What happens if a person dies during the year? Will you get a deduction? Will you get a partial deduction? We don't know. But this is not really tied to Social Security, but it was a workaround for the promises that were made during the campaign. Next slide. Auto loan interest. Now, if you can purchase a new car that was substantially built in the United States, has less than 14,000 pounds, you can get a deduction for the loan interest up to $10,000. You have loan interest of $10,000. That must be a very expensive car at a very high interest rate. But it is what it is, but it's a help as well. It's not available for business vehicles, and it's effective for tax years 25 through 28. Next slide. Sorry to go so fast. And what I have here, these are not all the provisions. We have 25 slides here. My presentation to my clients was 80 slides. So I just picked the ones that I felt applied to the audience here predominantly. Termination of energy credits. 2 of the credits have already expired. The last 2 down at the bottom, the clean vehicles for the used electric cars, or $7,500 for a new electric car, has ended last week at 9:30. However, for the new electric cars, if you had a contract that you signed by 9:30 and you made a deposit, even though you'll receive the vehicle after 9:30, you'll still get the credit. So that was a new provision that the IRS allowed. But the other credits, residential and clean energy credit, solar powers, wind power, geothermal heat pumps, that's a significant 30% credit with no limit on the amount that you can take. That doesn't expire until the end of the year. The energy efficient home improvement credit also expires at the end of the year. Doors, windows, insulation, heating and cooling equipment, air conditioners, HVAC systems. The credit's 30% of the cost up to $1,200. I live in a home here that is about 21 years old, 22 years old. It has the original water heater. And water, you could tell I'm from Philly. It has the original water heater. So WODER. So I know it's going to go. I know if I don't do anything, it'll go January 1st, 26. So I'm going to get that replaced before the end of the year to be able to get that 30% credit. So just a planning tip, consider energy credits before they expire. And then a new energy efficient home credit really applies to home builders who build a home and they get a $5,000 tax credit, but that ends June 30th, 2016. Next slide, please. State tax changes. If you're fortunate enough to be in this financial position, God bless you. But right now, the current exemption for you to pay any estate taxes upon death is $13.9 million or $27.9 million for a married couple. That was expected to go about half of that once that old tax provision expired, the TCJA. So there are a lot of people that are planning around that and made some changes in their estate planning to be able to ensure that that would not happen because they thought it was going to be reduced by at least 50%. But the new law reestablishes that, increases the exemption to 15 million for a single person, 30 million for a married couple, and that's going to be effective 2026. So that's a good change for those folks. And that involves a lot of people who own farms that have appreciated in value. So many people are forced to sell the family farm and be able to pay estate taxes. Next slide. Bonus depreciation. When you purchase an asset that you have to depreciate, a tangible personal property, you buy a business vehicle, you buy equipment for your business. In the past, you were able to deduct 100% of it in the first year. And then it got scaled down 80%, 60%. And in 2025, it's 40%. So this new law reinstated the 100% expensing that goes back to not all of 2025, but up to, for some reason, January 19th, 25. So starting January 25, you can deduct all the cost in 1 year instead of depreciating it over, let's say, 5 years or 7 years. I have a sanitation company. One of their trucks cost about $450,000. They count on those deductions each year, or they'd have a massive tax liability. So that's important for businesses that have high capital requirements. Next slide. Qualified business income deduction. If you're in business and you have a pass-through entity like an S corp, a sole proprietorship, a partnership, under the TCJA law back in 2017, they established this deduction, 20% of your net, basically 20% of your net income. But it's a complicated calculation that involves other things like the amount of equipment you have, the amount of W-2s, and the amount of profit. But basically, the gist of it is 20%. So that was made permanent. Certain persons were concerned that that would not apply. There is some other restrictions for specified service, trades, or businesses. If you're in the field of health, law, accounting, actuarial science, performing arts, consulting, etc., you have some other restrictions based upon your AGI where you may not get that deduction or get a lesser amount. So it's a good thing that it was reinstated. The SSTB laws still are in effect. And they also added a minimum deduction for someone who had just nominal income of $1,000, let's say a profit, and at least $1,000, they'll get a $400 deduction. So that one starts in 2026. And next slide. Form 1099 reporting. This is a good thing. If you're in business, you know what a nuisance it is to have to fill out 1099 forms for anyone that you paid in the course of business for whatever it might be. It could be bank, it could be contractors that work for you. It could be a bank with $600 of interest or more. Well, that's a different criteria. But let's leave it with the independent contractors. You had to fill out all these things if you paid someone $600, unless they were a corporation. So that threshold is being increased to $2,000. Those are going to be indexed annually, so you don't have that issue as costs rise, and that's going to be effective in 2026 as well, not 25. Next slide. These are the new rates. So we talked about that bump up effective 26, and those last two brackets you could see in the red on the right side. So no significant changes to the tax rate. So basically, that's where we are. Let me just go through something real quick. Who pays taxes in the United States? These are IRS statistics. I wish I had this in my, if I had kept it in my slide, but the top 1% pays 40% of the taxes in this country. The top 5% pays 61%. The top 10% pays 72% of the taxes. The top 25% pays 87% of the taxes. And the top 50% pay 97% of the taxes. The bottom 50 pay 3%. So basically, half the country at the lower level doesn't pay income taxes. So when you hear that this is a tax cut on the rich, I have to disagree. These numbers have historically been the same for years and years. So when you hear things like that, talk to your tax advisor, not necessarily to a politician who just mimics the byline of their party. So whether it's Democrat or Republican, just be careful of the information you receive. There's also a lot of misinformation on the internet about the new tax law. So be careful about what you read, and hopefully you'll have a good tax season this year as you file your 2025 tax returns.
Wow, I've got a lot. I've been writing as you've been talking, and it's amazing how much information there is out there. I started reading the bill on AI version of the summary and got through a little bit of it. But thank you so much, Nick, for all your information. It is very enjoyable. A little enjoyable for me because it's my industry, but I know that there's a lot of people out there that will be helped by having listened to this today. And we do thank you for being with us. And we ask you to join us for our next show when our guest will be Eric Parnell of Great Valley Advisors Group. So thank you for watching Money Matters TV.
Thank you.